Hello everyone, my name is Nimit Jogani and today we'll be focusing on the concept of time value of money. So what is time value of money? It basically means that a dollar is worth more today than it is at some point in the future. And that happens because you could earn interest on the dollar today and it would grow to be more than a dollar at some point in the future. So hypothetically, let's say you had $100 right now and you invested that $100 at an interest rate of 12% annually. So in the next month, you would earn a 1% interest rate, which would equate to $1 on that $100 principal. And therefore, your total value would be $101 one month later. So basically, it's explaining that your dollar is worth more today than it is at some point in the future. And time value of money basically focuses on these concepts of present value, future value, interest rates, so on and so forth. So what is a present value? So present value is basically known as the earlier money on timeline, which is basically the money that you have right now. And you would basically invest that for it to grow at some point in the future, which brings me to the concept of future value. So future value is basically known as a later money on a timeline, right? It's basically how much your money is worth at some point in the future, and that happens through interest rates. So interest rates are basically the exchange rate between the present and the future value. They also have some other interchangeable terms known as a discount rate, the cost of capital, the opportunity cost of capital, the required return. So now let's talk about the difference between the simple interest and the compound interest. So simple interest is basically the interest that you would earn on the principal amount, and it would stay constant every year. So you would not be reinvesting the interest that you earned, and that's why basically the interest that you would earn in a simple interest is just on your principal. So let's look at an example. If you invested $10,000 for 2 years at 4% per year, what is the interest and the future value in 2 years? So at the end of year one, you would earn interest of a total of $400, which is basically the 4% times the 10,000. You would also earn the same amount of interest at the end of year two, making the total value at the end of year two to be 10,800, which is comprised of the 10,000 principal and the $400 of interest earned in 2 years. So making it a total of $800. Now let's look at what compound interest is. So compound interest is basically the process of leaving your money and the accumulated interest in an investment for more than one period. So basically, what it's saying is that you are reinvesting your interest and you're basically earning interest on your interest. And that is called compound interest. Over the long term, compound interest can be exponential, compound interest can be significantly different than simple interest because you would earn interest on your interest. So let's look at the same example from what we saw in simple interest, but now let's look at it from the lens of compound interest. So again, you invested $10,000 for 2 years at 4% per year, but now it's at compound interest. So at the end of year one, you would earn $400 of interest, which is the 4% times the $10,000. So the value at the end of year one would be the 10,000 principal plus the 400 in interest, making it 10,400. Now you would earn, in year two, you would earn interest on the 10,400 and not the 10,000, making your interest in year two to be the $416. So at the end of year two, your total value would be 10,816, which is comprised of the 10,000 principal, the $400 interest in year one, and the $416 interest in year two. So because we reinvested our interest that we earned in year one, we got a 4% interest on that $400 as well, making it an additional $16 as compared to simple interest. Let's look at another example. So let's say you had a relative deposit $10 at 5.5% interest 200 years ago. So from a simple interest perspective, right, you would basically be, your $10 would be only worth $120 after 200 years. And it's because you would earn a 5.5% interest on the $10, which would be the 0.5. And that would be constant every year for 200 years, making it $110. And 110 plus the original principal of 10 would give you 120. But now if you were to look at it from a compound interest perspective, you would basically be earning interest on that interest over 200 years and making your total future value at the end of 200 years to be $447,000, 189 and 84 cents. So the difference between the simple and the compound interest would come up to be 447,069 and 84 cents. So now let's look at how future value is calculated. So future value is basically using the present value, which is the PV, times 1 plus the interest rate to the power t, which is the number of periods. And this 1 plus the interest rate to the power t is also known as a future value interest factor. Oops. So let's look at an example for future value. Let's say you invested $10,000 for 1 year at 8% per year. So I'm going to walk you through this example from the future value formula and just from a simple mathematical calculation, right? So from a simple mathematical calculation, the interest you would earn would be the 8% times the 10,000, which would be the 800 at the end of year one. So your total value at the end of year one would be your principal plus the interest, making it a total of 10,800. If we were to look at the formula that we saw on the previous slide, it would be the future value would be the present value, which is a 10,000 times 1 plus the interest rate, which is 8%, and to the power t. And in this case, it's only 1 year, so time equals 1, making it 10,800. So the 10,000 that you invested right now is your present value at 8%, which is the interest rate for 1 year, which is the time, giving you a total future value of 10,800. Now let's look at another example. Instead of investing that $10,000 for 1 year, we are now going to invest it for 2 years, right? So again, I'm going to walk you through the future value formula as well as just breaking it down year by year. So when I break it down year by year, we can see that the interest that you would earn in year one would be $800, right? Which is the 8% times the 10,000. So at the end of year one, the total value is 10,800, which is a 10,000 principal plus the 800 interest. Now for year two, you would earn 8% interest on the 10,800 and not the 10,000. So making your interest for year two, $864. So at the end of year two, the total value of the 10,000 is 11,664, which is comprised of your 10,000 principal, 800 interest in year one, 864 interest in year two. Now let's look at it from the future value formula perspective. So future value is basically a present value, which is a 10,000 times 1 plus the R. R is the interest rate, which is a 0.08 to the power 2. So time, in this case, we're investing it for 2 years, so it's 2, which translates into 10,000 times the 1.08 times the 1.08, which is again 11,664. Now let's look at another example. So let's say your company expects you to increase unit sales of burgers by 20% per year for the next 4 years, right? And you currently sell 4 million burgers in 1 year. So how many burgers do you expect to sell in 4 years? So we know that we are basically trying to calculate what the future value or how many burgers you would sell in the future. So currently we sell 4 million burgers, which is our present value, right? Times 1 plus R. So we are increasing we want to increase our unit sales by 20%, so it's 0.2. And we are doing it over a 4-year time horizon, so T equals 4. So it's a 4 million times 1.2 to the power 4, giving us 8,294,400 burgers that we would expect to sell in 4 years. So now let's look at what present value is, right? So present value is basically the current value of your money, right? It's basically the current value of any future cash flows that you may also have, which is discounted at an appropriate discount rate. So you're trying to figure out what is the value right now. So we've already looked at this formula, right? Future value equals present value times 1 plus R to the power T. And we're basically going to rearrange that to now find what the PV is, right? Given that we already know what our future value would be. So when we rearrange it, we would get present value equals future value divided by 1 plus R to the power T. And this 1 divided by the 1 plus R to the power T is also known as a present value interest factor. So basically present value and future value sort of are like reversals of each other, right? So in future value, we were basically multiplying it times the 1 plus r to the power t, right, to compound it to the future. But now, because we are calculating what the present value is, we are basically dividing it or discounting it and figuring out what the value is worth today. So looking at the formula, with present value, there's a few things to remember, right? So if you have a longer time horizon, your present value will be smaller and smaller and smaller, because from a formula perspective, you're doing future value divided by 1 plus r to the power t, right? So your denominator is going to be bigger as your time horizon grows, making your present value smaller and smaller and smaller. For a given length of time, right, the higher the discount rate, the lower the present value. So similar to time, if you have a higher discount rate or the interest rate, which is R, you would eventually have a smaller present value. So if you look at it this way, the present value and discount rates are inversely related, right? So increasing discount rates would basically decrease present value and vice versa. Same goes with time. So let's look at an example. Let's say you basically need $15,000 in 1 year for a down payment on a new house, right? If you can earn 9% annually, how much do you need to invest today, right? So we know that we need 15,000 at the end of year 1, which is our future value, right? So present value equals future value divided by 1 plus r to the power t. So our future value here is the 15,000. We know that our interest rate is 9%, right? So it's the 1 plus 0.09. And because the time horizon is 1, it's to the power 1. So it's 15,000 divided by 1 plus 0.09 to the power t, or basically 1.09 to the power 1, which gives us 13,761.47. So that is how much we need to invest today for our money to eventually become $15,000 at the end of year 1 at a 9% interest rate. Let's look at another example. So let's say you want to begin saving for your son's college education. You estimate that he will need $200,000 in 15 years. And you believe that you can earn a 7% interest rate per year. So how much do you need to invest today, right? So we know that we need $200,000 in 15 years. So $200,000 is our future value. 15 years is our time horizon, and 7% interest. 7% is basically our interest. So if you were to look at it from the present value formula, we would do present value equals future value. So that's $200,000 divided by 1 plus r to the power t. So it's 1 plus 0.07 to the power 15. Which will give us $72,489 and 20 cents. So basically, we need to invest this amount right now for 15 years at a 7% interest rate for it to grow to $200,000 in 15 years. Let's look at another example. So let's say your parents set up a trust fund for you for 13 years ago, which is now worth $18,856.49, right? So if the fund earned 5% per year, how much did your parents invest, right? So we know that currently, from a 13 years ago perspective, the future value is 18,856.49, right? And the time horizon was 13 years and the interest rate was 5%, right? And now we're trying to calculate how much our parents invested 13 years ago, which is the present value, right? So present value equals 18,856.49, right? Which is the future value, divided by 1 plus r to the power t, so 1.05 to the power 13. So that gives us exact $10,000, right? So our parents invested $10,000 13 years ago at a 5% interest rate for it to now be worth $18,856.49. So we had touched upon the present value relationships a little bit before, but let's look at it from a little bit of a deeper perspective, right? So like we had said, for a given interest rate, right, so the 1 plus r, the longer the time period you have, the lower the present value, right? And we can look at an example as well. So we are trying to find the present value of the $500 at a discount rate of 10% to be received in 5 years and in 10 years, right? So our future value is constant, our interest rate is constant, but only our time horizon is changing, right? So for 5 years, which the present value is the 500 divided by the 1.1 to the power 5, right? Which is the interest rate to the power t, which is the 5 years, giving us $310.46. Now let's look at it for 10 years. So again, our future value is again 500, our interest rate is 10%, but instead of our time horizon being 5 years, now it's 10 years, right? So it's 500 divided by 1 plus 1.1 to the power 10, giving us $192.77. So as we can see, the longer the time horizon, the smaller the present value. So they basically work inverse. Now, let's look at it from the interest rate perspective or the discount rate perspective, right? So for a given time period, the higher the interest rate, the smaller the present value. So similar to time, interest rate also works inversely to the present value, right? So a similar example, we are trying to figure out what the present value is of $500 received in 5 years if the interest rate is 10% or the interest rate is 15%, right? So at a 10% interest rate, our present value would be the future value, which is 500 divided by the 1.1 to the power 5, right? Giving us $310.46. But now, if we increase our interest rate to 15%, we would do 500 divided by the 1.15 to the power 5. So our time horizon is the same, our future value is the same. The only difference is in our interest rate, and that leads us to $248.59. So we can see that the higher the interest rate, the lower the present value. Now let's look at what discounting is, or basically what the interest rate is, right? So discounting basically means that you're trying to find the present value of a future amount, right? And the discount rate basically means that the rate that is either used to calculate the present value of future cash flows, or you're trying to calculate the future value of present cash flows, right? Basically, it's either multiplying it with the discount rate or dividing it by the discount rate. It's also called the rate of return, the return on investment, so on and so forth, right? So as we had seen this equation before, future value equals present value times 1 plus r to the power t, right? And now instead of us solving for future value or present value, we are now solving for what r is, right? So if we rearrange this equation, we would get r equals future value divided by the present value to the power 1 divided by t minus 1. So let's look at what a discounted cash flow means. So it's basically like I said before, it's calculating the present value of the future cash flow to determine what the value is worth today, right? The 1 divided by the 1 plus r to the power t is also called the discount factor, because at that point we basically use it to discount our future cash flow. We had also seen this on the slide for the present value. And when we talk about the value of something, think of it as basically present value until they explicitly state that they're looking for the future value. So let's look at an example for discount rates. So you're looking at an investment that will pay $1,500 in 4 years if you invest $1,000 today. So what is the implied rate of interest? So we know that our present value is $1,000. We know that our future value is $1,500, and the time horizon is 4 years. So we are looking at what would be the interest rate that would make this $1,000 go to $1,500 in 4 years, right? So our interest rate is basically the $1,500, the way to calculate using the formula is the $1,500 divided by the 1,000, right? The future value divided by the present value to the power 1 divided by t, so the 1 divided by 4 minus 1, which gives us 0.10668, which basically translates into 10.668%, right? So if we invested $1,000 at this interest rate today, 10.668% for 4 years, we will be basically earning $1,500 at the end of 4 years. Looking at another example, so let's say you're offered an investment that will allow you to double your money in 6 years. You have $10,000 to invest. What is the implied rate of interest, right? So we know that our present value is $10,000 and our time horizon is 6 years, and we are offered an investment that will allow us to double our money, right? So our future value is basically double of our present value, which is $20,000, right? So using the formula, R equals future value divided by present value, so 20,000 divided by 10,000 to the power 1 divided by t, so it's 1 divided by 6 minus 1, giving us 0.122462, which is roughly 12.125%. So you invest $10,000 today at a 12.25% interest rate for 6 years, giving us a total of $20,000 at the end of 6 years. And now finally, let's look at it from the number of periods perspective, which is basically solving for t, right? So again, this formula, future value equals present value times 1 plus r to the power t. So if we were to rearrange it, we would have to use ln, which is known as log, right? So it's ln future value divided by present value divided by ln 1 plus r. And let's look at an example again. So if you want to purchase a new car and you're willing to pay $20,000, if you can invest at 10% per year and you currently have $15,000, how long will it take before you have enough money to pay cash for the car, right? So we're solving for t, right? We know our future value is $20,000. We know our present value is $15,000, and we know that our interest rate is 10%. So it's ln 20,000 divided by 15,000 divided by ln 1 plus r, so the 1.1, right? Because it's 10% interest rate, which gives us 3.02 years. So if we were to currently invest $15,000 at a 10% interest rate for 3.02 years, that would give us 20,000 at the end of 3.02 years. And you can also reverse engineer it or you can also do a cross check, right? Basically applying this formula, so present value times 1 plus r to the power t, to see are you getting the same future value or not. Let's look at another example. So let's say you want to buy a new house, right? You currently have $15,000 and you figure you need to have a 10% down payment plus an additional 5% of the loan amount for closing costs, right? Assume the house you want will cost about $150,000 and you can earn 7.5% per year. So how long will it be before you have enough money for the down payment and the closing costs, right? So we know that our down payment was supposed to be 10% of the $150,000, which is basically the $15,000, right? Our house costed a total of $150,000 and we already had $15,000. So our loan amount is going to be $135,000 and our closing costs were basically 5% of our loan amount, giving us $6,750. So the total amount of money that we needed was the $15,000 plus the $6,750, which is a $21,750. So now we're trying to calculate our time horizon, right? So we would do ln future value divided by present value, which is the $21,750 divided by the $15,000, and then divided by ln 1 plus r. So our interest rate was 7.5%, so 1.075. So which will give us the 5.14 years, basically. So as the question had asked us that how long will it be before you have enough money for the down payment and closing costs? So basically, if we were to put our $15,000 at a 7.5% interest rate for 5.14 years, we would earn $21,750, which would cover our down payment and the closing costs. That basically marks the end of our time value of money concepts.